don't see the card. I just see an orange box. Good morning. I'm David Wessel, Director of the Hutchins Center on Fiscal and Monetary Policy here at the Brookings Institution. Today, we're going to talk about something that is economically important, but that many people haven't taken the time or have the patience to understand. How much capital should big banks be required to have? Regulators, the Federal Reserve, the Comptroller of the Currency, and the Federal Deposit Insurance Corporation have proposed to increase the minimum required capital to better compensate, they say, for the risks assumed by the 37 biggest banks in the U.S. who represent the bulk of the U.S. banking industry's assets. This is the final stage in the Basel III standard set after the global financial crisis, hence the name, the Basel III Endgame. Now, the banks say this is overkill and will starve the economy for credit, and they've been mounting an aggressive lobbying and advertising campaign to pressure the regulators to back off a bit. And I expect we'll hear from bank chief executives tomorrow at the Senate Banking Committee on that subject. Now, there are trade-offs to be made here. How much insurance do we want to force banks to have to protect the rest of us from financial crises? What are the benefits to the overall economy, and what are the costs? I'm pretty sure we're not going to resolve those questions today, but our hope is to shed some light on them, because so far much of the conversation has been an argument among people who make a living understanding the details of bank capital regulation, which is a pretty small fraction of the population. I'm hoping to bring the rest of us into the conversation today. I recently took a stab at explaining what's going on in an explainer we've posted on the brookings.edu website. But today we've invited 4 experts, all of whom have strong views on these questions. Let me just introduce them in alphabetical order. Anat Admati is the George G.C. Parker Professor of Finance and Economics at Stanford Graduate School of Business. Among other things, she's the author of a book called The Banker's New Clothes, What's Wrong with Banking and What to Do About It, so you can kind of tell where she's coming from. An expanded version of that book comes out in January. Greg Baer is President and Chief Executive of the Bank Policy Institute. That's a public policy research and advocacy group representing the nation's leading banks, so you can tell where he's coming from. Greg is a lawyer. He's worked at J.P. Morgan, Bank of America, Wilmer Cutler, the U.S. Treasury, and the Federal Reserve Board of Governors. Steve Cicchetti is the Rosen Family Chair in International Finance at the Brandeis International Business School. He spent 5 years earlier as head of monetary and economic department at the Bank for International Settlements. He and his colleague Kim Schoenholtz are authors of a money and banking textbook and a blog that bears that name. He happens to be a non-resident senior fellow with the Hutchins Center of Brookings. And Jason Goldberg is managing director at Barclays, where he's been for 15 years. He's now the senior research analyst covering large cap banks. He previously did similar roles at Lehman Brothers and at Citi. So welcome to all of you. If you have questions, you can put them, you can email them to us at events@brookings.edu or on Twitter at #bankcapital. And I thought we'd start first by Steve, by asking you, and then I'll turn to Greg. What exactly is bank capital? What is its purpose? And what's the role of regulation in setting the amount of capital that banks have to have?
So thanks very much, David, and thank you for inviting me to be with this very distinguished group to discuss, I think, what is an incredibly important question today. So at its very simplest level, capital is the net worth of the bank. It's the shareholders' stake in the bank. It's the difference between assets and liabilities. And importantly, it's a liability concept. It's a source of funding for the bank. So it's being used to purchase assets. It's being used to purchase cash, make loans, purchase securities, and the like. And it serves, I think, several important purposes. The first one is that it acts as a buffer that separates the bank from insolvency. So if the bank takes losses on its loans or on its securities portfolio, the first loss will go to the bank's owners, to the equity holders who are providing this bank capital to the bank, and that protects the depositors as well as the bondholders. Importantly, of course, as is implied, I think, in what I just said, bank capital is not in any sense idle. It is in use, and it's important to understand that, as I said, that it's a source of funding. The second thing is that it acts as a form of self-insurance to improve incentives and improve the incentives of bankers. If we can think of the bankers and the bank's owners as effectively having a put option, that is to say that they have an option where they get the upside, and if they go and become insolvent, the resolution authority, in the case of the US, that's the FDIC, and the public would end up with the bank. So the limited liability that the bank's owners have means that their loss is limited by their initial investment. The smaller that investment is, the more leveraged the bank is, the lower its capital funding level is, the more the owners and the capital providers are going to benefit from the upside, and the less that they're going to lose on the downside. So the point is then that higher capital improves the incentives of the bank's owners and managers to properly manage risk. Now, importantly, to get back to your original question about capital, it is important to keep in mind that it is difficult to measure capital. We're going to come back to this, I suspect, at various points. But because assets of a bank can be composed of, say, things that are extremely difficult to value. Some things could be quite illiquid and hard to value, as well as things that are intangible. And here examples are things like, these are strange accounting items that not everyone will surely understand or needs to understand, but things called goodwill or deferred tax assets or the like. Those things make it very difficult to actually compute the level of capital. So I would say that the degree, when we think about the size of the capital and the level of capital requirements that we want to think about those three things. We want to think about the size of the buffer, how big we want the losses to be, what the incentives are for the bankers, and how we might want to improve those incentives for them to manage risk well, and finally, the difficulties that we might have in measurement and how those difficulties might affect the level of capital that we ask the banks to have.
So, Greg, how does it look? Does it look similar to the banks?
Yeah. So, I mean, I thought that was a great description by Steve, and I think I'll just build on that and move from what's capital to what's capital regulation, and then what's this new Basel proposal. So, capital regulation is expressed generally in required ratios. It's not going to be that complicated, I promise. So if you have an 8% capital requirement, that's 8% of what is what? The 8% is, the numerator is how much capital you have. Used to be complex, but now it's basically common equity tier 1, or what you think of as common stock. And the denominator is your assets. So if you have $100 in assets and $8 in capital, you've met your 8% ratio. The complexity comes, though, with how do you think about those assets? You can treat all of those assets the same and just add them all up. But at that point, you're effectively saying you're going to require the same $8 against both a subprime loan and a treasury security. And that doesn't actually make a lot of sense intuitively. And also, it gives banks an incentive to hold riskier assets because they can earn a higher return on that capital. So the basic notion has been for some time that we want to have what's called risk-based capital standards, and we want to do what's called risk weighting the assets. So instead of treating them all the same, we will treat them differently based on the probability that there'll be a default and then the loss given that default. That's what the Basel proposal is all about. And what it's basically saying, or trying to do, is to make the system a little more risk sensitive than it has been. So, traditionally, 100% risk weight means you hold the full $8. A 50% risk weight means you hold $4. And that's kind of where mortgages were. So the new proposal actually doesn't treat all mortgages the same. It looks at the loan to value ratio, and it gives you a different charge based on what's going on there. That becomes incredibly complex. It is very difficult to do. If you are too broad in your applications, you come up with sort of dumb outcomes, like we're going to treat a subprime mortgage the same as a prime mortgage. But if you get too far into the details, then effectively you're doing credit allocation. So it's important to know in capital regulation, there's no right answer. It's impossible to satisfy everyone because you're either allocating credit or you're acting stupidly. But the 1,000 pages of that proposal is really about trying to make a series of choices about different assets and how much risk they hold. To give you one just in the weeds example, it's not just loans and other assets, it's even off balance sheet items. I think Steve mentioned this. So one that's been controversial is how much capital do you hold against an unused line on a credit card? So if you have a $10,000 line and you've used 1,000, should the bank hold capital against $9,000 even though you haven't borrowed that money from the bank? Well, the answer is, well, yeah, sure. The proposal actually proposes to double the amount. I won't get into the details. It's 5 to 10%. But that has a real consequence, which is banks are saying if that happens, we're going to cut lines. That has consequences because there are a lot of people who use those lines as sort of an emergency source of credit as opposed to going to a payday lender or something. So it's just an example of how a tiny little credit allocation decision in thousands of pages can have real world consequences, and sort of a lesson just in how this proposal actually has real consequences for real people.
Okay, we'll get to some of those things, but Anat, let me ask you, so do banks, in your view, have enough capital, and what are the pros and cons of a proposal which, like this one, which is pending, that requires the bank to hold, many banks to have more capital?
Right. Again,
let me get a nod in, then we'll get to you back.
Oh, sorry. I thought you meant me. Sorry.
Thank you for having me here. I've been in this debate for over 13 years, and the start of it was a paper by 4 of us that was called Fallacies, Irrelevant Facts and Myths in the debate on capital, in the discussion on capital regulations, why bank equity is not socially expensive. So, and shortly after we wrote this paper, 20 academics wrote a short letter at the signing of Basel III back in November, so 13 years ago, saying that the proposal is entirely inadequate. Basel III is far from sufficient, and we say specifically a few things that are relevant for this debate. If a much larger fraction, at least 15%, of banks' total non-risk weighted assets were funded with equity, the social benefits will be substantial and the social costs will be minimal, if any. And then we debunk a bunch of claims in a very short letter. We were constrained by the fact that the CEO of Citi had to publish an op-ed the next day saying some of the same fallacies, irrelevant facts, and myths. Something about return on equity, which I just recently gave to my undergrads at Stanford to debunk. And then specifically on risk weights, what we say is the Basel Accord determined required equity capital through equity levels through a system of risk weights. System encourages innovation to economize on equity, which undermines capital regulation and often adds systemic risk. The never mind the AAA securities and other things. There is much evidence of that. And in fact, what we see right now is essentially a weaponization of this complexity of the regulations, including what Mr. Baer was referring to, this sort of attempt to micro-calibrate these things and thus affect the bank's incentives. And so we also say on lending specifically, banks warn that increased capital requirements would restrict lending and impede growth. These warnings are misplaced. It's easier for better capitalized banks with fewer prior debt commitments hanging over them to raise funds for new loans. Secondly, removing biases created by the current risk weighting systems that favor marketable securities would increase banks' incentives to fund traditional loans. Third, the recent subprime mortgage experience shows that some lending is bad for welfare and growth. Lending decisions will be improved by higher and more appropriate equity requirements. Now, in the book that was mentioned, which I just yesterday got the second edition, which is 200 pages long. So, but it's not as long as the capital requirements, and only half of it is in text and the rest in notes. We argue strongly for a measure for equity levels that are actually not so finely tuned, calibrated to begin with, meaning to keep them between some numbers that I'll be thrown out of the room for saying 20 to 30%, aim for 30, let it go down to 20, intervene in time, way ahead of insolvency. Now, I should say This is about solvency. The measure is not even a balance sheet measure. We need the market value of the assets, not the accounting value and not the risk-weighted assets. We need the actual market value of the assets relative to the actual face value, actual liability.
Right. So let me
solvency.
let me make
And
sure
just to say, I come from an area and from the world of corporate finance where corporations fund with a lot of equity, and they, despite no regulation on it, there's nothing different about equity markets for banks and non-banks. If their stock markets go down, if they don't like it, that might just suggest to us that their business model is too much dependent on subsidies.
Okay, so I want to make sure I understand. I think you made a couple points. One is you don't like all the things that, including the one that Greg referred to, where they try and turn the dials on different risks, because you think that that may just have unintended consequences, leading the banks to do things that might be just to satisfy the regs, not to what's good business or good innovation. But in general, you think that banks should have a lot more capital.
Yes.
And you think you referred a couple of times to the social benefit. And by that, I assume you mean if I'm a banker, my primarily concern is my returns. That's my job. And you're suggesting that the society that the society may want them to hold more have more capital than that in order to protect us from
returns or not. We teach students to do net present value. Return is a function of leverage, and that's been, Nobel Prizes were given for understanding that, when you have less leverage, you have less required return, and stock markets price the risk every day for every company.
Okay. All right. So Jason, let me turn to you. So if you think about, if I'm a stock market investor, if I'm buying shares in banks, do I care about how much capital they have? And if they have to have more capital, does that make me pay less for the bank share or what? Jason?
No, good question. And we've heard, a lot so far. And Stephen gave a definition of capital. And I think one thing that's important is, there's only two places that banks get capital from is, one, the retained earnings, and the higher the ROE, the quicker the more earnings they have the ability to retain. And
ROE is the return on equity.
Or secondly, from investors. So it's important for banks to have the ability to, access the markets. If you think about, ROE, if a bank has a 17% ROE today, and its risk-weighted assets go up by 20%, which is kind of what we estimate the proposal will be, that ROE goes from 17% to 14%. Banks, the correlation between a bank's ROE and its price to book multiple, which it trades at, is 0.9. So the market is, I think, very much focused on the returns that banks banks do provide. So there is I think a couple of implications of the rule is, right, it does increase our risk-weighted assets banks have, and really nothing has changed in the riskiness of a bank between today and prior to this proposal. And in fact, if you kind of under the last Fed regime, they were pretty clear that this Basel III endgame wouldn't increase capital requirements, and in fact, this proposal absolutely does as is. And then secondly, for the regional banks, their capital goes down because all of a sudden now they're going to have to include certain aspects of AOCI, which we haven't talked about. But previously,
right. I'm trying to keep this as acronym free as possible.
Yes.
So previously, what you're saying, yeah, I know. Good
regional
luck.
banks will have lower capital as a result of some of the
because the banks now, some of the things, the banks have some losses on their bond portfolios, and they haven't had to account that when they do their capital calculation. And one of the big changes that this proposal makes is to require those banks to play by the same rules as the very biggest banks. So that means that they will have less capital, and therefore their ratio of capital, they'll have to raise capital somehow or shrink assets, basically.
Correct. So,
just ask a question. Is it the case that the analysts don't know this? They don't read I can see the unrealized losses. So presumably when they're computing the health of the bank, they're looking at that.
Absolutely. But from a regulatory standpoint, it wasn't a consideration. And now in a post-Basel III endgame world, it will be a regulatory consideration.
So, but if I think what Steve is saying, why should it make any difference to investors if it was already on the books? They just in a footnote rather than in the capital calculation.
Again, because banks today that are deemed well capitalized, all of a sudden are not,
I see.
and nothing actually changed.
I see. Steve, I'll get to you in a minute. So
Okay.
I don't. Anat makes the case that. Tell me what you think of Anat's case that we're looking at this the wrong way, through the wrong end of the telescope.
I mean, the case that the social costs of capital are likely to be very low, I think, is compelling.
So that means that the benefits of
That the benefits
against
and
subsidizing.
that the benefits are very high, I think, is compelling. But I want to start.
Can you define what you mean by the?
Yeah, I will in a second, but I want to start with the statement that when the bankers say that they think that capital funding is expensive, they are telling the truth. Okay, this is in fact true.
I want to write that down, Greg. I don't know.
No, it's true.
Not
that
socially, not socially.
No,
from
but to
a
the bank.
private perspective, it's true. It's true for two primary reasons. The first reason is the tax code, which distorts incentives by making debt cheaper than equity funding for the banks. That's a distortion that's created by the tax code, so it cannot create a social cost, and it is not a social cost. The second reason that they are telling the truth is because the more equity funding you require them to have, the smaller the value of the option is that they have. So it is, in fact, true that they are facing a cost. But of course, that option is an option to give the bank to the public. So that also cannot be a social cost. So these are private costs, but from the perspective of society, once I take into account the distortions that are in the tax code and the fact that the government and the people are going to bail these banks out in the end, because they always have, then the cost to society cannot be the same as it is to the individual banks.
All right. So Greg, please let me frame a question. You can say what you want to say. So I think the basic argument is, we understand the banks don't like this, and that's rational on their part. But if we could get the details right, having the banks forced to have more capital would be like buying more insurance against something like the global financial crisis. And while the bankers reasonably might not like it, and that's beyond all the details, things that you and I talked about, what's wrong with that rationale on the part of the regulator?
Sure. I'll get that. Just one correction on one of the things Steve said. It's actually not the public that's enduring the cost of these failures. It's the surviving banks. The FDIC has just completed its special assessment, and the price of SVB's failure will be paid by the nation's largest banks. I don't think the Deposit Insurance Fund has ever required, actual long-term taxpayer funding. It's a weird sort of system where it's actually a mutual insurance system. We can talk about that at some other seminar. It's kind of fascinating. But yeah, I mean, if you think about the proposal, again, I don't think there's any debate, certainly among anybody in the markets, any regulators, that as you increase the cost of capital for a given asset, you provide the bank an incentive to move out of that asset or reprice it up. To Steve's point, I mean, there's another way that the bank funding is cheaper. The cheapest bank funding is actually insured deposits, right? Actually, which nobody else gets to offer, right? Second, least expensive is market debt, and then third, of course, is equity. And so, Jason can attest to this, and I've just been hearing it actually at the Goldman conference. Somebody asked one of the CEOs, "What are your plans for the mortgage business?" And his answer was, "Well, we'll have to wait to see how the proposal comes out." I think another example that's gotten a lot of attention is tax advantage green energy investments, which the proposal quadruples the capital charge. I think all the banks involved have said that goes forward, they're going to get out of that business. So, you can talk about it in the macro sense of more capital is good. And, I think you can debate that, but that's actually not what this proposal is about. What this proposal is about is choosing at a micro level which types of assets or exposures to advantage over others. And you won't see banks going out and raising capital. They're not going to do an equity offering. What they're going to do, and if you listen to earnings calls, and I encourage everybody who wants to learn about this to do that, you hear bankers saying, we're going to optimize the balance sheet. Here's what optimize the balance sheet means. It means we're going to get out of things that have high capital charges relative to the economic value we put on that asset. And that's why you've seen, and that's sort of the thing a lot of people are talking about now, even in some of the regulators, is, it's why banks are a small minority of the mortgage market now. And most of those risk is held at Fannie Mae and Freddie Mac, and the largest originators are Rocket and Quicken Mortgage. It's why you've seen a massive growth in private capital, and now private debt, which we didn't used to think it was a thing, but it's now in the trillions of dollars. And some say it's bad because it's getting pushed to the unregulated sector. I think that's less important. I don't know that regulation makes anything that much safer, but what it's doing is being pushed into a sector that charges more and is less likely to continue providing that credit under stress. Because again, back to the great advantage banks have and pay for, they have deposits. They have insured deposits, which don't run, and then they have uninsured deposits, which generally don't run. There's a notable case in March. But that makes them
have access to the discount window.
And that's a very good point. Yes, absolutely, David. And I think that if we get to liquidity regulation, I think that's going to become more and more important and ought to. But that makes them durable through the cycle lenders. And that's why you want them to keep making loans as opposed to having hedge funds or venture capital funds or whoever making those loans. And that's what's at stake in this proposal. It's not some esoteric debate about the optimal capital level. It's especially in light of the fact that, and I think Jason mentioned that when they announced the Basel Accord, they said, we're not intending to raise capital requirements. You've had now post-2010 any number of economic cycles where the banks have shown no sign that they are significantly undercapitalized, as this proposal presumes, particularly in capital markets, which this proposal hits absolutely the hardest. It's an estimated 70% increase in capital requirements for market trading. So, principal at risk market making. There's been no indication that function is undercapitalized, that it is done well through ups and downs. Most famously, what you saw in 2020 was whereas the Fed stress test would have predicted that they'd lose tens of billions of dollars, they made tens of billions of dollars. So if you live in the real world, it is hard to see anything since 2010, during which, by the way, the average, the banks have doubled or tripled their capital levels, to indicate that they are currently significantly undercapitalized.
So
and therefore,
you're making two arguments here. I want to make sure I get it. One is a lot of the specifics you think are just going to drive banks to put their money, move their business in ways that we may not want to do. You mentioned high loan to value rate mortgages is one, which I've heard a lot about. But you're also saying that even if it weren't for that, you don't think there's a case for asking the banks to have more capital, period.
Well, there may be some pocket of risk. And again, if you think about this proposal, actually the capital charge for commercial industrial loans actually goes down a little bit. So it's all very episodic, or not episodic, asset or exposure specific. I think in general, in every case, it's probably overstating. I'm sure there's a contrary case. But again, as you look at and the other thing is we have real world experience. The very largest banks are running what's called the advanced approaches, or an internal models based approach. We have the results of that. And it shows that the real world risk weights that are necessary to compensate for actual losses and loss given default are significantly lower than what's even in the Basel proposal, much less what the U.S. regulators have added to the Basel proposal.
Okay, and Anat is about to explode. I don't want to.
Yes, I have about 15 things to say.
And you can tell because she makes faces and nods her head.
I know.
Yeah, you have a very good poker face.
I'm going to be much more professional.
I don't have poker face. Okay, I don't even know where to start. First of all, there are many the subsidies of debt, to tax subsidies of debt, are available to all corporations, and we never see corporations live on so little equity as the banks without any regulation in the real world. So I want to understand why they have ROEs that they could increase by borrowing and they don't. In the real world, that around me here in Silicon Valley, etc. So this entire reasoning is fallacious. What we're talking about is all these subsidies. Tax subsidies are incredibly distortive, and that's just bad for even for mortgages, but so also for corporate debt. The capital ratios are entirely mismeasured. just to mention, they were fined for First Republic and for SVB as they failed. So they are not reflecting the true market value of the assets, and banks are insolvent. Now, in my own research, I know how heavily what's different about banking is really the extreme indebtedness that pervades all the time. And that's what we're hearing here. When you have such enormous debt overhang, you behave differently than other corporations. No other corporation talks about what they'll do or not do based on their funding. Only banks. Why is that? It's because their funding is so privileged and so debt-based. And that has to be corrected, brought back to markets. To my diagnosis, as if you want a corporate doctor, I would say that they would not survive in markets, and investors will not agree to support such heavily indebted, such opaque corporations with equity. So they will reflect that if you increase equity. Now, one final point. We have research showing the adjustments to ratios and to when you tell banks to require to ratio. And some of these adjustments are not efficient and not good for the economy and would cut assets. What we recommend is different tools. The tools do force banks to issue more equity at the price that the market will bear. And the market is telling them what their equity is really worth, and that's a good thing. That's the true market test, stress test. If you cannot raise equity, which is exactly what happened to SVB, then you're really insolvent. But otherwise, you're hiding your insolvency. And that's what we see in some regional banks right now.
Okay, so Greg, before I get back to you, Steve, so Annette makes the point that banks are obviously a lot more leveraged than industrial companies, right? That's always been the case. Why should I think of banks and General Motors and Tesla in the same sentence? Aren't banks different given the role they play
for equity?
Right, but given the role they play in the society and the fact that the government essentially stands behind them? Steve?
So, yeah. I don't know. Greg's got his hand up.
I could.
No, you go first.
I want the economics professor first.
You'll be brief and level-headed.
I think that I don't. It's dangerous to put words in Annette's mouth, but let me just say that I don't think she's arguing that banks should have the same. That banks should have the same debt to equity ratio, the same capitalization as an industrial company. Okay, I think that it is the case that industrial companies tend to have, say, 50%, maybe a third, maybe the most leveraged one's a quarter, but it's less. It tends to be much higher equity. It's like 50%. I mean, most households have higher equity than that. So I think that's not the point. The point is that it should be higher than it is today, and significantly higher. I think that Greg made a really great point at the beginning when he said that this thing is getting really far too complex. I don't think, Greg, that unlike some of my friends, I actually don't think that the Bank Policy Institute is like entirely Darth Vader, only on the way. Maybe you're gray rather than black. But
I think of myself as Luke
complex. I agree.
But anyway, the point is that the complexity is actually really bad. The complexity is bad for many reasons, some of which you mentioned, is that the complexity can lead to a lot of unintended consequences because of interactions between what's on page 25 and what's on page 2025. And I have no idea then, no person could possibly, or even AI at this point, probably figure it out. So I think we do need to think about simplicity, but the simplicity that I would like us to think about is similar to the simplicity I think that Anat wants us to think about, which is, let's get something really simple and let's assume that people are going to take a lot of risk. And then assuming that they're going to take a lot of risk, what's the right level of capital, of equity funding under that assumption? And so, at that point, maybe we can make this thing 5 pages rather than thousands and thousands of pages, but it's going to end up being equal weighted, and we may have some exemptions, but it'll end up being equal weighted. It'll be a leverage ratio.
So,
Greg, your turn.
I mean, there's a reason banks are more leveraged than other companies. It's because they hold much less risky assets. So banks hold a lot of reserves at the Federal Reserve. That is a riskless, completely liquid asset. If an auto company held that asset in the trillions of dollars, by the way, collectively for the industry, it would be a lot more leveraged, right? A AAA rated bond does not require a lot of capital to offset the risk of that default. Now, there are other assets that are more risky, a subprime mortgage, for example. But you can't compare leverage ratios at banks versus industrial companies that take dramatically more risk. And then, I mean, I'm not sure I understood everything Annette was saying, but I mean, I would just say, you know, banks have taken this amazing privileged position in all their subsidies. And I think I'll turn it over to Jason for more particulars, but they've managed to translate that into trading generally for most, I think, of the regional banks below book value, below tangible book value. They have dramatically underperformed the rest of the S&P 500 since, I think, 2010 to an extraordinary extent. If anybody wants it, I will send you a chart on that. So clearly, investors, the market, are not perceiving this as a sort of Pollyanna, idealistic, subsidized, wonderful industry. The word you hear most these days among analysts is uninvestable. So if you have an industry that's uninvestable in the eyes of a lot of people, is trading below book value, and is seeing capital migrate out of that industry into practically every other industry, that does not seem like a ripe time to be raising capital requirements on that industry. But Jason knows the numbers a lot better than I do.
Jason, why is that? I mean, and does that apply that the market thinks that they are risky and that they ought to have more insurance?
I wouldn't say the market implies it's risky. I think you've created, a lot of uncertainty, particularly with this proposal and what the ultimate impact will be, because right now it only answers higher capital, but there's several businesses, that have, I think increased question marks around them. And, will banks have the ability to increase price and pass it on to the end user to make these businesses palatable? Are they going to have to exit, certain businesses? If you think about, this year alone, you've seen Truist exit student lending. You've seen U.S. banks scale back mortgages and auto lending. You've seen, Citizens Bank just recently exited student lending. And so you're seeing business, banks feeling compelled to pull back to kind of optimize or reduce kind of RWAs in anticipation of this increased capital requirements. And, this year we have data back to the 1930s, the worst year for relative bank stock performance in history. Now, part of that.
What do you mean by relative bank? Relative to
the S&P 500, so relative to the market. Now, I'm not going to say that's all due to the Basel III proposal. Clearly, you had, 3 of the 4 largest bank failures in history, contributing to that. But, you do have this kind of, cloud around the consumer. And if you think about it, financial services is something that the U.S. banking industry exports globally. And now with this proposal, on several aspects, you're putting the banks at a disadvantage to their global peers. And is that going to inhibit their ability to compete?
Okay, so let me ask you,
as well as international banks operating in the U.S.
Let me ask you to put on your hat as not only a bank analyst, but as a citizen. And, we have seen some big banks run into trouble. Some of them during the global financial crisis, and you just pointed out that we had the failure of SVB and First Republic, which fortunately didn't turn out to be as big a deal for the economy as many of us feared at the time, but it did provoke a fairly substantial response from the federal government. So how do you weigh what you just said, all those things about citizens getting out of student loans, with the risks that we've seen of financial crises, and how do you weigh those things when you think about it if you're not looking only at bank stocks? Isn't it worth something to have lower the odds of a financial crisis?
Absolutely. There's a cost to a financial crisis. And I think coming out of, the 08-09 financial crisis, there were, we had, the introduction of Basel III, for example, which by definition means Basel I and Basel II weren't good. And you did have a substantial increase in capital. It gets to a point where there's too much capital. And I think that's something we have to be cognizant of. And, listen, had Basel III endgame in effect on Jan 1, I don't know if that would have changed the outcome of Silicon Valley.
Right, I'll get to that. But
If you look at the failure of Silicon Valley, it was a result of interest rate risk mismanagement, not understanding, too concentrated deposit base.
yeah, but the depositors left because they thought the bank was insolvent. If the bank had had more capital, maybe somebody would have fled. Right?
I mean, also they left because they all knew each other around the same.
Yeah.
email
Okay.
chain,
Well,
which is
we
not-
can all agree who to crucify that one. Yeah.
I think it's a separate debate, but I would contend had the Basel III been in place, it wouldn't have changed the outcome there, all else equal. So
Okay. So let me ask you all a question that, a number of the banking groups have said that this will lead to less lending. And they make that point, even though most of the increased capital is in the different buckets, in the operational risk bucket and in the market risk bucket that Greg referred to, the trading activities. So I want to know from each of you, will this result in less lending, or is that just a palatable argument because it's easier for people to understand than all the complexities? Steve, do you want to start?
Sure. I'm gonna use my privilege just to be here for a second to make a couple quick points, because I failed in my previous answer to say that banks provide liquidity on both their liability and asset side. That's their business. And so they have to have a lot of debt on their liability side, or they will not be able to do that. This is a little bit, I would say that's a nuance of what you said, Greg. That's a little bit different, but they're doing it on both sides. They tend to be good at it, and they are who in society, we've assigned them that job. And we have to make sure that they can still do that job, because we want the payment system to work, and we want people to have lines of credit. I do have a comment about the ROE thing. I find it very odd that banks should expect ROEs of pharmaceutical companies. And the reason I find that odd is that pharmaceutical companies face actually existential threats of lawsuits if they start killing people, but banks don't. And so that sort of seems odd. The other thing is that if you're lower risk, which you will be if you have more capital funding, then you should be willing to accept a lower ROE, because of course the idea here is to have risk-adjusted ROE. Now, on the issue of lending, the first thing I want to say is that we thought in 2007 we had too much debt and too much lending, and now what we're saying, and the economy is booming, okay, and now what we're saying is, for some reason, that we want more. We want to make sure that lending doesn't contract somewhat. Well, it's contracted a bit, but not hugely. So I think that I do not think the evidence suggests that higher levels of capital funding reduce lending. I think higher levels of capital funding, if you look cross-sectionally across banks that are better capitalized, actually turn out to lend more. They lend more cheaply. They have cheaper funding, and they lend to more creditworthy borrowers, because the banks that are bordering on hitting their regulatory requirements or have very small buffers are going to tend to gamble for salvation. They're going to lend to people who will not be as likely to repay. Finally, let me just say that I find it a bit surprising that the idea of retaining earnings rather than doing share buybacks is somehow going to reduce lending, because of course that would be the natural way for banks to increase their capital funding. It would be through earnings retention. So is the argument here somehow that earnings retention reduces lending? I find that a little bit odd.
Greg, you want to respond?
Sure. Just a couple of things. Let me lower my hand. On the effect on lending, and this, maybe we'll talk about operational risk, but the Basel proposal has three components: credit risk, operational risk, market risk. the operational risk capital requirements affect lending because they're basically ascribed to one business or another. I'll give you one example, very, again, in the weeds. If a bank originates a loan and sells it to Fannie and Freddie, they actually hold that loan on their balance sheet for, I think it's like 60 to 90 days. Under the proposal, that gets an operational risk charge because the assumption is something will go wrong. And that has dramatically increased the capital requirement and would give them a huge disincentive to continue that business. So just an example of how operational risk requirements translate over into credit. It gets very complicated. On Steve's other point, and I want Jason to talk more about that. On the ROE, I mean, fair or not, banks compete on ROE against other companies, including pharmaceutical companies. I think one of the ironies and sort of bitterness here, and this is a far field, but if you think about the existential risk to the pharmaceutical company that they will pay a huge fine if they kill a bunch of people. Banks just, I think, have collectively paid over $2 billion in fines for not monitoring the personal phones of their employees. They paid after the financial crisis, I think, tens of billions in fines for not having what do you call it? What do you do with you when you the notary public in the same room as the person whose mortgage foreclosure documents they were notarizing, with no proof that that ever made a difference, that any loan would have been improperly foreclosed upon. That was tens of billions of dollars in fines. So banks actually are receiving, they wish they killed somebody. It's a lower fine.
I don't think I want to say that, but is that a reason that
you get a higher fine at a bank for an AML violation than major industrial companies have gotten for.
But I thought that was the argument. So you have operational risk, the risk of getting fined or losing a lawsuit, and the regulators are saying, okay, you should take that into account when you decide the riskiness of your business and how much capital you hold, right?
Well, I think there are 2 points on that, David. I will do because I've written, and if anybody wants to look it up, I've written a fair amount on operational risk. I mean, there are 2 issues there. One is a question of correlation. Actually, Governor Waller at the Fed raised this, which is, if you're going to get an AML fine, is that correlated with a market risk event and a credit risk event? What this proposal
AML, anti-money laundering,
or sanctions, or not, looking at your employees' phones. Well, the answer is there's no reason to believe that's correlated. So why do you presume perfect correlation and require all the op risk capital to be held on in a worst case scenario, to be held on top of all the credit risk capital in a worst case scenario, on top of all the market risk capital in a worst case scenario, plus a Fed stress test that's a worst case scenario? So why is that all additive as opposed to assuming, well, $1 of capital can take care of different things at different times? The other is back to the worst case scenario. Banks have paid billions of dollars in fines, but when you actually do the work, and we've put out some research notes on this, which I commend to you, the amount of capital required under this proposal is multiple times the worst experience ever. And that's just the Basel proposal. The Fed stress test, again, has a further charge. So even if you were going to say, oh, it's perfectly correlated and we're going to require a worst case scenario for op risk, this is 3 to 5 times what that is. And I think that's why there's been a pretty broad recognition that this thing got overcalibrated, and then is even further overcalibrated once you get to the Fed stress test. And, we're putting out research. There's actually a body, I'll commend them, called ORX, which is basically a data repository for actual operational risk data. Operational risk losses, which the banks globally report to. You can access that data and you can calculate how much do you need in a worst case scenario. And this is, again, multiples of what you need in a worst case scenario. And that's, again, presuming perfect correlation with market and credit risk losses.
Okay, so in that simple question, will this proposal discourage banks from lending as much or make them charge more for their loans?
Oh, I'm sorry. I should have answered it. Again, it's asset by asset. Again, as I noted, I think a more granular risk weight under the proposal is generally better in terms of a capital charge. Commercial industrial loans is a good example where you would get less under this approach than under the standardized approach currently. It gets even more complicated because there's an internal ratings-based approach,
right,
that the banks use, and I don't think we can get into that in the time we have
so
left.
You think won't make more less lending in general, but less lending for certain things, you're saying?
Yeah, and again, it depends on how you allocate the op risk capital. It depends on the Fed stress test. There will certainly be less lending than there would be, I believe, if this thing had been properly calibrated. So the biggest example is, they took the Basel risk weights for mortgage and just added 20 basis points to them.
Right.
Well, if you don't add those 20 basis points, there'll be more lending than if you do. And the actual risk weight that's probably valid, if you look at actual loss data, is probably less than half of that. So, again, it's very asset dependent and it's incredibly complicated, which is why they pay Jason the big bucks.
So Laishan, can I ask you first, answer? Do you agree with everything that Greg said? Will this reduce lending in certain areas, and if so, which areas? And
You asking me? Okay.
No, let me ask Jason first. Then you can attack them both. It's more efficient.
I do agree with a lot of what Greg said. I think there's there's a host of areas. Greg kind of touched on mortgage, particularly higher LTV mortgages for first-time home buyers. We mentioned how it impacts unused credit card lines. It also has a higher risk weight for it treats transactors and revolvers a bit differently, so that's going to weigh on lower end consumers, and have them potentially less access to credit card.
Can you define your terms of transaction and revolvers? Transaction, someone who just pays their credit card every month and doesn't borrow.
And then lower end
someone who's borrowing money.
Exactly. And then, operational risk actually plays into the credit card business as well. At the same time, the CFPB is now going after credit card late fees. So you're really potentially reducing the access the lower end consumer has, to credit. The way you look at Basel, for smaller private small businesses, there are different nuances on risk weights versus public companies, so potentially putting them at a disadvantage. And there's obviously a lot of small business, middle market companies. And then we haven't talked about it, but market risk RWAs increase. That potentially adversely impacts the cost of hedging, whether it's farmers or corporates kind of hedging interest rate risk or other market participants, liquidity in the marketplace. So not necessarily lending, but liquidity and hedging also has implications as well.
Can I just give one? I just wanted. I promise to be, but just to pick up on one thing Jason said, because I think it's a good example of the proposal. So the proposal generally has a 100% risk weight, so that's that full $8 for loans to businesses. It then has a 65% risk weight, so less, if you are a business that is internally rated by the bank as investment grade and has securities listed on a national exchange. What that effectively does is disqualify small businesses, mid-sized businesses that don't issue securities that trade on whatever exchange, as well as the whole funds business, because funds don't list securities. And you could say, okay, well, maybe that's right. Maybe they're more risky because they don't have securities listed. And actually, one of my colleagues, Francisco Covas and another economist, have done research, and they've shown, using historical data with a robust data set, that if the bank rates it in investment grade internally, the loss given default and the probability of default are no different based on whether you have securities listed or not. So it's like little things like that, but that will make a massive difference to the ability, and that's why we're starting to hear from small businesses. And they're all about Washington now. That will make a massive difference in the competitive ability of small, mid-sized businesses versus large businesses.
So you're basically arguing that you've avoided saying that you're okay with. It's almost as if you're saying if they want to raise the capital requirement, that's okay. They don't like it, but you're really interested in turning the dials a little bit to one side on a lot of these specific things. Am I reading you right?
Yeah, I think, and maybe I disagree with Steve here. I mean, I think it's okay to make. I think it's good to make the system more risk sensitive than it is.
Right. To charge, if you have a real bank that's making a lot of risky loans, have them hold more capital than a bank which is only buying treasuries.
Correct. But even within asset classes to make it. But the other really odd thing about this proposal is that the most granular and accurate way to assess risk is to use bank internal models that actually look at loan level detail. Since 2014, the very largest banks have been doing that. It has been, by all accounts, a success. There's never been any accusation that they're misstating the risk. There's a whole system of compliance and audit and examiner oversight and backtesting to supervise that process. And not more importantly, equally important, the Basel Accord of 2017 actually said, well, we have some worry that there'll be unwarranted variability among what different banks are producing with their different models, but we're going to let them continue to do it. But we're going to have that subject to what's called an output floor, where it can't be less collectively than 72.5% of what the standardized government model shows. So that was the grand compromise of Basel, which was continue to allow internal models because they're more granular and more accurate. But just to make sure that there's not unwarranted variability, we're going to have sort of a parameter around that. And what the US proposal has done without explanation is to say, no, we're not going to do that at all. We're just going to put everything at 100% risk weight. We're not going to allow use of internal models at all. And we're going to go 100% to basically set the output for not at 72.5%, but at 100%, only for US banks in an approach that has not been adopted by Europe or the UK, or to my knowledge, any major jurisdiction in the world. So we will, after this proposal is adopted, if this proposal is adopted, I should stress, be the only country in the world where your capital requirements for credit are set solely by government models. And what's even odder is the regulators actually allow banks to use their internal models for market risk, which is significantly more complicated than credit risk, and for the Fed's stress test for credit risk. So it's hard to escape the notion that perhaps they're not using internal models simply because they're producing a lower capital charge than they might prefer for political or other reasons. But there's certainly no data to suggest that those models are less accurate as opposed to dramatically more accurate.
Okay, and can you answer, I understand your point about what you would like to see the system be, but given this proposal, do you think the banks are correct in saying, as Greg and Jason have said, that this is going to end up with less lending, particularly in the areas where the risk weights have been dialed up?
It's possible. I think that, so I cannot say for sure. What I'm saying is that on the margin, the problem is not one of lack of funding. The problem is one of what you want to do. And you're telling me you want to maximize your profit, so that's what you're going to do. Now, some loans are made, so you can't have it both ways. If the loans are going to be made by somebody, then that's maybe okay. As it turns out, research by colleagues of mine showed that non-deposit taking lenders, Quicken and these others, shadow banks, have much more equity, and they're not even regulated to have they have twice more than banks. So that's that. And I don't also have a lot of sympathy for the argument about international comparisons, to the point that the Credit Suisse affair, which was not mentioned here but is relevant, shows us that cross-border and systemic resolution is just dead, is not workable, is never going to work. And it's just not going to happen. Therefore, we start questioning the need for actual global banks that have operation in multiple jurisdictions, are systemic in multiple jurisdictions. If you cannot fail, that's not a capitalist economy. That is above the law. And that's not okay with me. Having corporations as big, as complex, and global that cannot fail is very dangerous and very unhealthy. So for me, I think we have to revisit that question of too big to fail. Dodd-Frank promised us to end it, and it didn't.
Well, I mean, I remember Credit Suisse a little differently. I think the equity holders were all but wiped out. It gets very complicated around why they got a little smidge left. In fact, the long-term debt holders, what they call AT1 in the US, but we call it like in the United States.
No. 50 billion was never touched. 50 billion Swiss francs.
AT1
were not. AT1 was just 17.
Can we get back to the US case?
No, they suffered a total loss on the AT1.
Okay.
Just AT1.
Those were very, Greg, you'll agree, those were very weird bonds.
Yeah.
That was 15 billion. Those were $15 billion worth of bonds that were subordinated to equity.
Yeah.
That the other stuff, the next tranche up, was not touched. The TLAC was not touched.
The qualifying TLAC.
This is. I think we need to.
We're off topic, but I think Credit Suisse is an example of how the TLAC requirement works, not how it doesn't work.
Okay. So we'll do that another time. So a couple of people have asked the question. This is something Greg raised. Steve, I'd like you to start. Like, if we ask the banks to hold more capital, particularly against some of these have more capital, particularly against some of these assets that are deemed risky, the argument is made that this business will just leave the banking system and go to non-bank financial institutions that are not as regulated. One person suggests that the banks will just simply finance these risky companies outside of the regulated banks, and that might make even financial instability more likely because we have much less visibility into them and they have less of a safety net. Someone else says that aren't we increasing risk in the system if the risks tend to migrate to less well-capitalized players? So I think that's arguments made a lot. That basically, if we have a regulated system and a lot more lightly regulated system, we'll just chase the business out. A, do you believe that? And B, should I worry about it?
So the first thing is that the banks are the most leveraged, lowest capitalized entities out there. It's complicated to figure out what leverage is in some other types of institutions because of derivatives exposures. But by and large, banks are probably, I don't know, anywhere from 4 to 6 times maybe more leveraged than people outside of the banking system. And so I actually worry much less about non-bank intermediation and the instability that it could cause than other people do. We've seen a lot of things that look like large events outside of the banking system and turn out not to be very important. If it's the case that banks are lending into those institutions, then of course the banks are facing the same risk charges and the same capital charges, the same operational risk charges that they would otherwise. It may be that those institutions are better at managing the risk than the banks are, in which case they should be treated better in the capital requirements. I actually think that the movement of finance outside of the very highly leveraged banking system is largely stabilizing. The movement of it into the markets, which is a lot of what's going on here, is also largely stabilizing. And the movement of it into other private securitized or funded and purely funded and market funded entities also looks to me to be stabilizing. Let me make one very small point, which is that that since 2009, we have not seen a serious recession which didn't come along with incredibly high government support for everybody. So it's very hard for me to look at the data and say, oh, credit risk is actually really low, because I have no idea what's going to happen if we actually have, let's say, a run-of-the-mill pre-2007 recession, which I think, looking at everybody here, we're all old enough to remember, where we have, a year of minus 3% growth. I just don't know what's going to happen. It could be that we're going to be better off. It could be that we're not. But anyway, I do have actually quite a bit of sympathy for Greg's point about the IRB approach. But I will say that one of the reasons that for the output floors is that there was a incredible variance across banks in their risk weights. I mean, on the order of 2 to 5 times. When we did the original calculations for the calibration of Basel III, which is now also seems like prehistory, but there were incredible variations. So in some sense, they brought this on themselves.
So
Well,
Jason,
I just say,
please.
Steve, I think I take issue with that and point you, and I'll send it to you, but we have a research note coming out, I think this week, on warranted versus unwarranted variation in bank reported,
But is it agreed that the risk weight for the same asset should be the same across banks? Is that not?
It's a little nuanced. So probability of default should be the same. Loss given default probably should not be the same. So the easiest example is, imagine 2 banks. One has a large workout group. The other, just puts you into bankruptcy and sells the loan. They should not have it. Interestingly, apparently some of the variation is caused by regulation and examination. So it's very subtle, but my colleagues, I think Greg Hopper, Francisco Cavas, have a note coming out imminently, basically taking a deep dive look at this. I'd really recommend it. And then I guess the only other thing I'd add to what Steve said, I mean, I don't think it's leveling off. I'm just reading a Morgan Stanley report that says the size of the private credit market was $875 billion in 2020, has grown to 1.4 trillion now, and is estimated to go to 2.3 trillion by 2027.
That's a pretty small number. Look at the bank's balance sheets.
Oh yeah, no, but look,
10% less.
Yeah, but I mean, mean, a lot of this just comes down to, do you believe in maturity transformation? Do you believe there's a social benefit to banks issuing insured deposits and having discount window access? And, back to, banking 101, the basic notion is the reason you do that is that gets people loans cheaper. I don't think anything's really changed about that. And also, as I was noting earlier, it gets people loans even in dark times because banks continue to fund because their depositors generally hang around and the discount windows there, et cetera. But maybe that's a whole nother,
So you're not making the case that we're going to have more financial crisis because of this private credit thing. You're saying when times get bad, those guys will not be in the business, and we might not have the same maturity transformation. That's
We don't know.
David, I think that's a good question. I think to the extent that they're not short-term wholesale funded like a Lehman or
Right.
Stearns, then yeah, that's less of a risk of a financial crisis.
Right.
On the other hand, you don't know. I mean, there's been a lot written recently about the hedge funds that are incredibly leveraged around a certain trade. I don't know enough about that trade to know the systemic risk inherent in it. Actually, Jason might. So I think it's not clear that it's more systemic risk. I just don't know.
See, Jason, so what do you make of the argument that we're just going to chase all this business outside the banking industry, and that's a bad idea? Not for the banks, not only for the banks, which obviously want the business, but for the rest of us.
Yeah, no, I think Greg makes a good point. It'd be interesting to see where private credit is when the economy really weakens because they don't have the stable funding that the banks do from depositors. They're relying on market funding, which could dry up very quickly. I think the other important consideration is I think banks and non-banks financials sometimes have different objectives. I think banks approach customers as relationships. They do multiple products and services, for those companies. In many instances, they've had these customers, for 100 years in some cases. So when a loan goes bad, they actually work with the borrower to come up with a solution. Whereas, private credit, I think has different objectives and different relationships, and it's solely on a financial return. So you think about how this whole, what's going on in the office sector at the moment is playing out. You've seen banks, in many instances kind of restructure loans, work with borrowers, have borrowers put more equity in, and, try and work out the situation where you've seen, some private or hedge funds or private equity investors just take the building and sell it at, fire sale prices to be done with it because there's just a different relationship there. It sounds to me like one of those outcomes is better than the other for society as a whole.
What do you make of the argument that we're going to chase a lot of business out of the regulated banking industry? Should I worry about that? Let's say it's true. Should I worry?
I'm not as concerned about it, and I also think that a lot of the shadow banking goes, if you trace the money, into the banking system itself. So I don't know that this system is not connected at every level within it. Money market funds are a shadow bank in the middle between a depositor and a bank. And so, the risk just starts, being still around, but just being counted differently and all of that. So I worry about chasing the risk to some extent. And I think it's in the system. Now, what I also didn't say about lending is that, we don't go around asking that much, except in the vaccine case, what a company invests in. A loan is an investment for the bank. We don't usually micromanage that. Why we have, some loans are good and some loans are not at the price that they are charged. Now, we're talking about subsidizing some loans. My big picture point really is for all of us to think about who we want to subsidize and for what purpose. If there is a group of people, so for example, we give a tax deduction to mortgages. Not all countries do that. That is really regressive, and that doesn't make any sense. If we want to subsidize first-time homeowners, we can give them, a tax credit for a down payment on a house, rather than subsidize high-income people to borrow to buy a house. You have Peter Thiel here taking a huge mortgage to buy a mansion. Why is that? Should be that subsidized by taxpayers? That doesn't make sense to me. So that's at the mortgage level. So what I'm saying is, they're just subsidies and they're given in distortive ways. And I think that's unhealthy for the entire system. And that is true for the fact that the economy is very debt fueled, and that we keep talking about loans without asking, why do people need a payday loan? Why is there so much? Why are people living on borrowed money so as much as they do? I understand the role of debt in the economy, but I think we have excessive uses of private debt in general, and subsidies going straight to debt as opposed to what we want.
Okay, so we have a couple of minutes left. I was going to ask each of you to make one big point about bank capital. You already spent your minute. So, Jason, if you were speaking to members of Congress, readers of the Wall Street Journal and New York Times, people who don't live and breathe this thing, what is one thing they should know about this bank capital proposal?
I would just say, there is something as too much capital. And I'm concerned this proposal as is, goes too far. And I think, the Fed has talked a lot about the need for consensus. And you've had a lot of dissents already, both from the Fed and the FDIC. And I suspect there'll be a lot of comments, and I just hope they're all considered in the final proposal.
Well, I think Michael Barr said on the record they're going to make some changes. He even gave a list that familiar topics. Greg, what's one thing you think people should know about the proposal?
I think just in terms of how to propose the proposal, you don't have to be a weatherman to know which way the wind blows. And if you just look at what's happened over the last 10, 15 years, is the problem that there's not enough capital in capital markets for the dealers? Or is the problem that market depth is way down? And in fact, we have gross concerns about illiquidity in those markets. And we've had the Fed having to bail out the Treasury market both in 2019 and 2020. On the credit side, again, are we seeing banks with massive credit losses that are bringing them down? Or are we seeing, credit migrate out of banks to other institutions? It seems like all of the actual weather seems to indicate, as Jason said, that, almost without exception across asset classes, banks are amply well capitalized. And we haven't even talked about the fact, the Fed puts a lot of stock in its Fed stress test. They've been running it every year since the crisis. Every year it says the banks have ample capital. Were they wrong all along? I think whether it's that experience, which obviously the Fed's test is hypothetical, although they use actual balance sheets, or whether it's what's actually going on in the market. I think if you do a reality-based assessment of bank capital, we've got plenty.
Steve, last word.
So many things to say, so little time. I had a rule when I was in Basel and we were working on this, and my rule was that if the people that are creating spillovers and systemic risk, the people who are creating risks of financial crises, are not screaming at me when I'm trying to get them to actually internalize the costs. If they're not yelling, then I'm not doing my job. So my job now is to ensure that I am helping so that the people in the banking system and in the financial system are screaming about this because I want them. If they're not screaming, then I'm not being tough enough. So I find this conversation, it's very illuminating. I really appreciate all of the points that Greg and Jason have made. I think that hopefully we've all made coherent points, but in the end, my view is we have to raise capital requirements. We have to make sure that the banks have sufficient capital funding so that their incentives are aligned with those of society, not with those of their managers and the like.
Okay, well, I said at the beginning that I knew we weren't going to resolve the questions, but I hope we could shed some light on them. And actually, you all exceeded my expectations. Now, that may have something to do with my expectations, but I want to thank you all for being so clear and even at times succinct, which is always a challenge in these things. I suspect that we'll be doing this again and again and again and again. This isn't going away, but for now, I want to thank you and all the people who dialed in.
And thanks, David. That was a great job of moderating.
Thank you. Thank you very much, David.
Thank you all. Bye-bye.